So today is our 1 hour basic 1031 exchange principle seminar. So those of you that may have heard the more complex presentation, some of this is going to be redundant. For those of you that are new to 1031s, this should be a very useful presentation and a primer for the more advanced topics. Those of you that do not know me, you will by the end of the presentation. I'm a senior VP with Asset Preservation. Asset Preservation is a nationwide qualified intermediary. Although I'm a lawyer, I cannot give legal or tax advice in my role as a qualified intermediary because it conflicts with my duties as a qualified intermediary. This means that you will need to have a real estate lawyer engaged in connection with your sale of your relinquished property and also in connection with the purchase of the replacement property. And it also means that I work as one of the team members with the players in the putting together the sale, putting together the purchase. So I am a team member with the CPA, with the real estate agent or broker, and I can get a call regarding a deal from any of these people to start the deal. So all of you are involved in one time or another in the 1031. It is very critical, those of you that are investors in the audience, that you do involve your CPA early in the process. And that means before you've sold your relinquished property and not after you've completed your exchange, because after you've completed your exchange, it's simply too late for your CPA to provide any guidance or any direction with respect to the transaction. Okay, so enough about my background because I think most of you know me and I really want to get into information that's going to help you and your clients. So you can see on the screen what we're going to cover today. Again, if you were in the presentation yesterday or possibly the one 2 weeks ago, you're going to hear some of the same information. Next week, just so you know, we have a 1 hour presentation with Brad Borden on the new proposed definitions of real property under Section 1031. So that should be very enlightening, particularly to the real estate brokers and agents on the commercial side, as well as the tax attorneys. All right, so the first thing with respect to 1031 is that what we are deferring is our capital gain taxes, and our capital gain taxes are comprised of federal, state, and local rates. For most of our clients, they are in the federal level. At the federal level, they're going to be taxed at 23.8%, which is a combination of 20% applicable to high income earners, the 3.8% net investment income tax, and then in addition, they may also have depreciation recapture at 25%. So on the federal level, it's either depreciation recapture at 25 or 23.8%. if the 3.8% is applicable. It's not both. So if you have a $3 million gain and you depreciated the property $2 million while you owned it, on the federal level, you're going to get taxed at 25%. And then on that $2 million, and the balance of the $1 million gain on the federal level, if you're a high income earner subject to the 3.8 net investment income tax, you're going to get taxed at 23.8%. Then on the entire $3 million, you're going to get taxed at the state rate because we can't get enough taxes involved in our sales of investment property. And that in the Northeast is somewhere between 6 to 8%. And then if you are fortunate or unfortunate enough to either be residing in or have your property located in New York City or one of the boroughs, there's an applicable local tax of almost 4%. So we've got an awful lot of taxes involved in the sale of investment real estate today, and I don't see that decreasing, given the fact that all of our states and local jurisdictions are really strapped for money. If anything, that amount could actually increase, I'm afraid. The high income earner rate for 2020 applies to, the threshold is single filers exceeding 441,000 of adjusted gross income, and married filing jointly in excess of 496,600. Every year that goes up slightly. The threshold for the 3.8% investment income tax is lower. It's 200 for single and 250 for married. So if you're a high income earner for purposes of the 20% rate, you're automatically going to get hit with a 3.8% tax if that applies to you. Yesterday, someone had a question in the event whether this net investment income tax applied to real estate professionals who really have active income, and the answer is for the most part no, but you must check with your CPA because there's all different types of income no matter what you are, whether you're a real estate professional or otherwise. So you have to actually go to your CPA to confirm what is your tax liability. And what I say to investors that call me is that I unfortunately cannot tell you what your capital gain taxes will be. I can give you a generalization such as I've just given you, but when it comes to actually determining how much federal, state, and local tax you're going to owe, you've got to speak to your CPA. That's really critical. Because you could have a capital loss that would offset the capital gain, of which I am completely unaware. So very important to involve your CPA. So now let's take a look at Section 1031. I repeat over and over in all of my presentations that there are three basic requirements of every 1031. And the first is that we must be buying and selling real property held for productive use in a trade or business or for investment. Both what we sell and what we buy must be held for investment or trade or business use. Now, the word in red was added in the Tax Cut and Jobs Act of 2018. Before that, the word real was not in this sentence, which, by the way, is Section 1031. And you might say, well, is that it? Well, it's accompanied by about 4,000 pages of regulations. So there is the devil's in the details, as always, with law and tax matters. So the word real property was added. Now, what happened at that time? We got real property, so we knew we couldn't do purely personal property exchanges, but we didn't really get any definition of what the IRS considered to be purely real property. So a week or two ago, we got proposed regulations of what the IRS considers to be real property. And it is, I would say it is taxpayer friendly. It expands as opposed to decreases the realm of what is real property. In today's event, I'm going to talk exclusively about real property that is property that is clearly real property under existing law. Next week, we're going to talk about some types of real property that appear now to be qualified for 1031 purposes. And I will give you an example of something that is really a very important type of new property that may qualify, and that is options and contracts to buy and sell real property. Traditionally, we've always considered contracts and options to be personal property unless, and we get a tax attorney involved to opine that the investor has had the benefits and burdens of ownership of the property as if they really were on the deed, even though they have an option. And usually what that means is they've been paying the taxes, they've been paying the bills, they have all liability, all income from the property, and so forth. So now it appears that under the proposed regs, things may go further than that, and there may be some ability to qualify options and contracts. Now remember, you still have to pass muster and establish that the interest has been held for investment. So to determine if a property or an interest of any type has been held for investment, the IRS looks at about 8 different factors, and they are listed on the screen. And it's all about the client's intent when they purchased the real property and while they held the property. So what was the intent when we acquired that piece of dirt? Was it to build a building and sell the building? Or was it just to hold the dirt until the surrounding area became more established and then possibly sell just vacant land? So intent is a big issue, and because the IRS cannot obviously see what's in our heads, it's very, very critical to document your intent and show in your actions and in your documents what your intent is with respect to any property that you may acquire. Certainly you can write your CPA and your lawyer to say, the intent of buying this property is to hold it for investment, but then your actions need to mirror that. So you can't immediately list the property for sale. You can't do things of that nature, which would result in possibly the IRS saying you primarily held it for resale. So the opposite of held for investment is primarily for resale. You do not have to amount to a dealer to disqualify yourself for 1031 purposes. A dealer is somebody who sells property in the ordinary course of business to customers. That's like a Pulte Homes or a Toll Brothers, that they buy property, they build on it, they sell homes. The test to disqualify you from 1031 treatment is at a lower level. And if you are determined to primarily hold for resale as opposed to investment, you would be disqualified. So one of the factors that the IRS will look at is the period you own the property. It's not determinative. It's one of the factors. And you can own property for a very long time and still not qualify, as the Allen case demonstrates, which I think I mentioned in the next slide. So the liberal view is 1 year. Anything less than a year of ownership, you're going to have an uphill battle, because to the IRS, if you've owned it for shorter than a year, you bought it to sell it, and you're going to have to prove otherwise. And this conservative view is 2 years. We want a clean holding period. We don't want resale activity during whatever period you are asserting is the period of time you held for investment. You want it clean without resale activity. Resale activity can include listing the property with brokers for sale, can include substantial improvements. You know, you bought vacant land and you built a building. So that's going to result in resale intent as opposed to investment intent. Doing nothing is good investment intent. A couple cases at the bottom of the slide that I'm going to skip over for the moment because I'm running a little behind here, but these two cases illustrate that the IRS will definitely look at the facts and circumstances, and they get very particular when they are auditing and to determine if you held for investment intent. Both of those cases are cases where the taxpayers converted the replacement property to primary residence property shortly after acquiring it. And in one case, they were disqualified, the other one not. You really do not want to convert your replacement property to personal enjoyment property or to primary residence for at least sometime after the 2-year period, or you will open yourself up to audit. Okay, so all of the types of property that you see on the screen are considered like kind to one another. So we not only have to be buying and selling investment or business property, we have to be buying and selling like kind. Now, like kind is a very broad definition under Section 1031. It doesn't mean you need to be selling commercial and buying commercial, selling residential and buying residential. It means you have to be buying and selling investment or trade or business real property that has been held, that qualifies under the code. So that includes, we see farmland, we see timber rights, and I'm going to explain some issues regarding rights that aren't the whole piece of real estate. At the bottom right, we might see a vacation home. I see a swimming pool. So maybe that's a vacation home. So it has to also be like kind. And you're going to find out shortly that you can have real property that is not like kind. And that arises mostly in the cases where we have an interest that's not the entire fee. For instance, water rights, timber rights, air rights. When we have those type of rights, we have to make sure that it's like kind. And typically that means that under state law, the state considers it the kind of interest to be real property, and that we are giving up the interest into perpetuity or for a very long time. So air rights in the Northeast are typically considered real property, and as long as you're giving it up into perpetuity, like kind to a fee. So we tend to do a lot of air right transactions in the Northeast. Similar rights in other jurisdictions might be mineral rights, water rights, timber rights, and things of that nature. And again, if you were giving up the timber rights for 2 years, even if the state law considered timber rights to be real property, you probably wouldn't qualify, because even though it's real property, it's not like kind, because it's not being given up into perpetuity, and therefore it's not going to be considered like kind to a fee simple interest. And that's where you have to double check when you are buying and selling less than the entire piece of dirt. Leasehold is a good example of this. Anytime you have a lease of real property, you're leasing a store, you're leasing a home, it's real property. But it's not like kind to a fee under Section 1031 unless it is a very long-term interest. And in the case of a leasehold, if you are buying or selling a leasehold in a 1031, in order to be like kind, so to qualify for 1031 treatment to buy a fee interest, it has to have a remaining term of 30 years or more, including unexercised option periods. So this might mean that you have a 10-year lease with 2 10-year options to renew. Your landlord's terminating the lease because they're going to sell the building and they want to give you $5 million. You can consider that sale or termination to be the sale of a real property interest and 1031 it. And likewise, you can buy a leasehold on the other side. Again, to qualify as like kind to a fee, which is what you need, it's going to have to be a very, very long-term lease. You can't just lease something for 5 years. That is not going to be considered like kind. So another type of interesting real property is our Delaware statutory trusts. Now, I simply mention this in this particular slide presentation is I'm trying to illustrate the different types of interest that may qualify under Section 1031. Delaware statutory trusts, I only include one slide. We have an entire presentation, but they're codified under Revenue Procedure 2004-86. What you are acquiring when you buy a DST interest is a beneficial interest in a trust, which typically beneficial interest in a trust are considered personal property and would not qualify for 1031 treatment. This is an exception to the rule in that the revenue procedure has very clearly indicated that interest in DSTs qualify as real property. And the reason I mention this particularly now is because of the COVID-19 issues, we're having a lot of trouble closing on replacement property in our 1031 and finding it and closing in our time periods. And DSTs, if you are somebody that is interested in a passive investment, they are quick close, customized to meet exchange equation, which we're going to hear about shortly, and available. You don't go see these buildings. The trust usually owns 2 or 3 buildings. They're institutional grade assets, and you get the information in a private placement memorandum that is supplied to you by a licensed broker, dealer, financial advisor, because these interests are considered securities for security law purposes, even though they're real estate for 1031 purposes. So just remember that. That is an available real property option. So another type of interest that we get confused and we think it's real property are partnership interests. So the partnership or the LLC is on the deed. Does the partnership or the LLC own real property? Yes. But do the individual investors in these entities? No. So they own partnership interests only, which are, number 1, personal property, and number 2, specifically excluded from 1031 treatment under a specific section of 1031. So you cannot buy and sell partnership interest. This issue comes up every day. In my longer seminar, we talk about partnership solutions and what you can do if you do have a partnership interest and you want to 1031 your interest separate and apart from the partnership. There are 2 basic scenarios. You can have a drop and swap or a swap and a drop, and basically it involves converting the partnership to what is known as tenants in common. But this is not just a matter of preparing a deed and giving every partner their pro rata interest of the asset owned by the partnership. You also have to abide by the formalities that are to evidence that you are truly a tenant in common and no longer a partnership. And that actually takes some time. So doing something like this right before you're getting ready to sell may hinder your ability to evidence that you are truly a tenant in common. And if you have not done that, if you have not had enough time to establish that you're a tenant in common, you may be considered by the federal or state authorities to still be a partner, and even though you 1031'd your interests separate and apart from the partnership, disqualified. So again, this is an issue that we go into depth on in the longer seminars, and a swap and drop is where you keep the partnership intact and you buy your replacement property in the partnership name, hold it for a couple of years, and well, at least a year anyway, and then distribute the interest in the replacement property to the partners pro rata. Notably, you cannot use these techniques for corporations, whether they're an S or C corporation, because this technique and this tool is for partnerships only, because only partnerships have the attribute under the tax code of being able to distribute property pro rata to partners and having it non-taxable. We can't do that with S and C corporations, so you have a completely different set of obstacles if you are trying to separate shareholders for purposes of a 1031 and they are shareholders of an S or C corporation. If I've got clients that don't want any risk, they will often use the swap and drop because the partnership stays intact, doesn't have a risk of not being considered held for investment because it changed tax ownership right before closing. It just stays intact and does its exchange. There are also many other partnership solutions and things we can talk about if you are selling in a partnership and want some options. But really the purpose of this slide is just to point out that partnership interests are not a property and you have to convert to tenants in common if you want each of the investors to do separate 1031 exchanges. Okay, the second basic requirement of every 1031 is that we trade up or even and spend our equity. So I'm going to give you a couple of examples. The first example is where we're selling for $5 million, and in this example, we didn't trade up or even, we are trading down in value. So trade up or even would have meant I was buying $4.7 million of replacement property. Where am I getting 4.7? Well, we're allowed to pay out of that $5 million sale price without tax liability what are known as our exchange expenses, which in this case are our $300,000 indicated there. And I will go into more depth as to what that $300,000 is comprised of shortly. But that means the balance of the value is 4.7, and it's the value you need to replace, whether that's comprised of debt or equity. That's the number you're trying to replace. So the debt has to be replaced in full by new debt or cash from another source. In this case, the client traded down. They only spent $2 million of their 2.5 debt and only $1 million of the 2.2 equity. So the result is they have $1.7 million of boot. Boot is taxable and is the value that was not spent in replacement property of your relinquished property sale. And it is cash boot and mortgage boot are pretty much taxed the same. Even though you didn't get any money in your pocket, when you reduce the debt on the property, you received consideration and you didn't pay tax on it. So you will have to at this point. Now, if you are going into an exchange and when you call me, you say, Pamela, I only want to perform a partial exchange and I want to put money in my pocket. It's incumbent on me to make sure we get your CPA involved if you can't answer all the questions about your adjusted basis and how much your tax liability is, because if you are trading down and it's your intent to trade down at the very beginning of the exchange, we need to verify that you're going to still get a benefit from the exchange. And if you trade down so much that the leftover boot, in this case $1.7 million, is equal or greater to your capital gain that you would have had to pay tax on if you did a straight sale, you haven't gotten any benefit from the exchange. So I can give you a verbal example here. If we are selling for $5 million and we're replacing $3 million of property and our basis, adjusted basis in the property is $1 million, well, in that case, we would have roughly had gain of $4 million and paid tax on $4 million. So we're better off with a partial exchange. We did get some benefit. But if I change the facts and I say my adjusted basis in what my relinquished property that I'm selling is $4 million, then guess what? We would have only had $1 million of tax liability or gain that we were taxed on if we did a straight liquidation. And our boot is $1.7 million, so we're going to pay tax on the $1.7 million up to the full amount of our gain, which was $1 million. We got no benefit here. So that's why we look at this. If you're going to do a partial exchange, and will you tell me up front, we're going to look at that issue up front. Now, if this can happen by design, which was my example, or accident. Accident is we intended to buy $5 million or 4.7 worth of replacement property. We just weren't successful because of COVID or who knows what in actually acquiring all the replacement property we wanted. And we had leftover boot. We did our best. We only did a partial exchange. So now let's talk about what this $300,000 is comprised of. So there are certain expenses you can pay at closing out of exchange proceeds and not incur capital gain tax on them. And those expenses are listed at the top: transfer taxes, broker's commissions, attorney's fees, QI fees, and title insurance fees, all when you buy your replacement property. So those fees are what the $300,000 is that we basically took out. Other fees, costs that you pay out of proceeds, if you do, are going to create a tax consequence. So typical costs that we see are prorations, real estate taxes, rents, and other prorations. And if you owe that at closing, let's say your prorations end up with a credit to the buyer on a $5 million sale of $200,000. And that's shown on your statement as a credit against the proceeds. That is taxable boot. Now, if it's for real estate taxes, it may be deductible, so you may not care. It may be a wash. But if it's for other things, if the credits are for items that are not deductible, such as security deposits, that is totally boot and it is not deductible, so you're going to care if that is a sizable amount of money. And how do you deal with that? So real estate lawyers, when you're closing a transaction, if you see that there's a credit against the purchase price, a red flag should go up because that credit is going to result in boot. You need to address it with the client and possibly their CPA to determine if it's going to make a difference to the client. And the way the workaround is the following: anytime there are credits against the purchase price on the sale, is for the seller to bring that money to closing. So you take the security deposits out of your bank account and you bring them to closing, or you pay them outside of closing to the buyer and note that on the settlement statement, so there is no credits. If we are getting financing on our replacement property, that can be because we're replacing debt that we had on our relinquished, or we're trading up and we're getting debt for the trade up. But along with the debt comes what? Lender-related fees. Lender-related fees are not clear-cut exchange expenses. What does this mean? You might have fees for points, you might have fees for environmental reports and other due diligence that the lender required. There's many other types of lender fees. One significant type of lender fee is usually they will want on the settlement statement a reserve for taxes, maintenance, and insurance, future operation of the property. And that can be the most significant of the lender-related fees. So what does that do to your exchange? In that $5 million example that I gave you, what if the reserves are $500,000? That the lender's requiring? Well, unless you bring that money to closing separately or the loan is grossed up to cover that fee, the IRS could take a position that your equity that was supposed to go into buying replacement property was used for costs related to the future operation of the property, and that is not good. That is going to result in boot. So if you're going to use one of the solutions of bringing extra money to closing or grossing a loan amount up, it's important to also indicate on your closing statement how these non-exchange expenses are getting paid so that there's no confusion if the IRS comes knocking, or the state, to show that we did not pay these fees with exchange equity or proceeds. We paid them with other funds. So to put you in the clear. Okay. The next basic requirement of exchange is that we have to abide by our time periods, which are getting completely diluted by the extensions that were being granted. So I'm going to first explain to you what in normal times are our 1031 deadlines. And then I'm going to explain what's going on currently with the COVID extensions, to the best of my ability, given that we have no clarification yet on some issues. Okay, so first of all, the diagram you see is how it appears when we perform a forward exchange, which I'm not going to really get too heavily into the other formats of an exchange in this shorter presentation, which is the essentials. But basically, we're going to have the qualified intermediary holding only the equity in the deal. We do not hold real property in a forward exchange. You sell within 45 calendar days from closing. You need to identify all your replacement property, and within another 135 calendar days for a total of 80, you need to close on everything you intend to buy. Okay, so those are rules that have been around since 1984, and they haven't changed. The 180 days traditionally can be cut short if your tax return is due or filed before the 180 day. So usually if you are closing in the fall of a year and you're an April 15th filer, you're going to make sure your CPA gets an extension of your tax return due date and does not file it, so that you get your full 180. That's important to remember. So now let's address the extensions. The extensions that were issued on April 9th are more or less moot at this point, with some limited exceptions. So let's talk about what happened on April 9th, why they're mostly moot, what applicability they have, and where we're going from here. So on April 9th, long after the emergency had been declared in March, we finally got a ruling that noticed that under 2020-23, that anybody that had a 45-day or 180-day deadline, whether that was a forward or a reverse exchange, and that deadline fell between April 1st and July 15th, the deadline was automatically extended to July 15th. So if I had an April 2nd 45-day deadline, it's now July 15th. If I had an April 2nd 45-day deadline, this notice didn't come out till April 9th. Trust me, that person gave us an identification because everybody was calling, we didn't know. So likely that if you gave us an identification before this notice was issued, you may not like your identification. So you're able to revoke it until July 15th. Anytime before your identification period is over, an exchanger can always revoke and re-identify, but it's a formal process. So you have to follow the formal process for revocation. So under that notice, we only got extensions of folks that had deadlines between April 1 and July 15th, which means if you had a deadline that was March 28th, you got no benefit and no relief from the statute. This notice did not refer to Section 17 of Revenue Procedure 2018-58. That revenue procedure is the disaster relief Rev Proc. This is what generally we look to, and it's generally the revenue procedure which controls when we have a natural disaster. And Section 17 of that revenue procedure provides that you get an extension if you're an affected person to the date specified in the notice or 120 days after your deadline, whichever is later. So the consensus right now from the tax attorneys I'm speaking to is that 120 days applies. We at API are very conservative, and what we're saying to our clients is live by your July 15th deadline. If you cannot, then seek tax advice to see if you can hang your hat on the 120. We hope within really the next week that we receive clarification from the IRS, and we hope that clarification says you get either or, whichever is later. If that's the case, then a lot of people are going to have a lot more relief. And for instance, let's say you're closing today on your sale of your relinquished property. This Rev Proc would do you no good, not the Rev Proc, the notice would do you no good because your 45 days is after July 15th anyway. So, but if it's one or the other, and if you're an affected person because you are within the April 1st to July 15th closing period, then you get the 120, and that is a significant additional relief. Also means if your 45 days is extended, you have all that additional time to revoke. It really changes the lay of the land very, very considerably. And I'm getting a lot of questions from clients who today would like to close on the sale of the relinquished property and are concerned about, well, I don't want to tell the buyer I'm ready to close because I don't know how long I have, and I still can't get out of my house very well to go look around at properties. And I want to travel. I want to go to Florida to look at properties, and I don't want to get on a plane. So we're having stagnation in the marketplace because the extensions are not clarified at this point, and we need some clarification. So hopefully I will have an announcement for you sooner rather than later on those extension deadlines. And by the way, they extend reverse exchange deadlines too. So if we're parking property and you haven't been able to sell your relinquished property, we're parking the replacement, you have more time to sell your relinquished property. So the identification rules, this is a third basic requirement of every exchange. So those of you that are beginners, I don't want to leave you out. We have to satisfy when we identify one of these three rules. The 3 property rule basically allows you to identify 3 properties. That's it. If you want to identify more than 3, either because you want more backups or because you want to buy more than 3, maybe you want to buy 5 properties, then you need to abide by the 200% rule. And that rule says anytime you list more than 3, it's okay, you pass muster as long as the fair market value of everything on the list does not exceed 2 times what you sold for. So that's a critical issue. You got to do some math. Typically, people do not send their ID into us until close to the end of the identification period, whatever that date might be at this time. If it's July 15th, we'll probably get a lot of IDs on July 13th or 14th, because if you ID and then you change your mind, you're going to have to revoke and re-identify. If you fail first and second rule, what do? You have to rely on the 95% rule, which I've never seen happen in all my years, 15 plus years doing 1031s, and that states that if you identify more than 3 and fail the 200% rule, you're okay as long as you buy 95% of what you identified, which virtually means you have to buy everything. Here's a little bit of how you revoke in case you're one of those that wants to revoke. It's a formal process. And here's an example, that you could revoke before July 15th. If July 15th turns out to be your extended deadline, if we funded a deposit out of your 1031 proceeds from your sale on replacement property and you're no longer buying that, guess what? The deposit gets returned to the QI, not to you, or it's going to be tainted. We put it back in your 1031 account and you can use it for your future purchases. I want to mention a little something on restriction on exchange proceeds, because again, with these extended deadlines, it's going to become important to understand the G6 restrictions. So the G6 restrictions prohibit the qualified intermediary from releasing funds we're holding for you, except in certain circumstances, until your exchange period is over. So it's a legal requirement. And if we violate that, your capital gain taxes will likely be due because, we are now no longer a QI, and probably everybody we're handling exchanges for would be tainted as well. So we're not going to violate the G6 restrictions. The G6 restrictions say that until your 45-day period, you are able to end your exchange on the 45th day, simply by not identifying. So whatever your identification period is now, let's say it's July 15th, you're going to say, okay, I decide I'm not going to identify anything. July 14th, 15th comes, you haven't identified, you get your money back on July 16th because the exchange is over. There's no way you're going to complete it. Once you identify and your identification deadline has passed, you cannot get your funds back until you have acquired everything on your list. The end of the exchange occurs, which is typically day 181, subject to the extensions, or your tax return is due or filed. So you are locked in. And I can't say 180 day because it now might be 180 plus 120. we have to figure out how these extensions apply to our timelines to determine how long we may be locked up and when we can get our funds back. So I say to you, if you're beginning an exchange, pay attention to these rules as they are, as the timelines are extended by the extensions that are in place. Right now, we're living with July 15th. If you close on one or more properties within the original or extended ID time frame, it's identified you're done, okay? You can still revoke the rest of your identifications. Scenario 2 is you've got multiple properties, your ID period is over. So now your exchange period does not expire until the earlier of the date the tax return is due or filed. All property identified is acquired, or the 181st day arrives as extended. I had a client that was past their 45 days, not their 180th had not, as extended, had not expired. They had identified one replacement property, were under contract. Contract was canceled due to COVID-19 issues. What happened? Well, the one exception to the G6 restrictions is the occurrence of a material and substantial contingency beyond the control of the exchanger and anybody that they are related to. So anybody that's not a disqualified person. So it has to be beyond your control, beyond your CPA's control, beyond your broker's control, beyond your attorney's control. And it has to relate to the exchange and to the property. And if that occurs, and you can substantiate that, it permits us to early release exchange funds. And because their contract was canceled due to COVID, because they'd identified nothing else, they were able to establish a material and substantial contingency had arisen. You don't want to rely on that. You really want to understand when you're going into a 1031 under the existing extensions, how long your funds could possibly be locked up for if you decide you don't want to go forward. So that's an important issue to be addressed. Okay. I'm going to be switching gears now to talk about something else that's going on a lot in the world today because of COVID and the difficulty we're having getting our buyers to the table, the buyers getting their financing, getting a buyer in the first place, and then, of course, finding our replacement property. So seller financing is on the rise. What is seller financing or attempt for seller financing? Seller financing is simply this. I'm selling a property for $5 million. The buyer agreed to pay $5 million. He had a mortgage contingency for $3 million in the contract. He was going to put $2 million down. His lender has gone south. Now the buyer wants to go south. I don't want everybody going south. I want my deal to close. So what can be done? Well, my plan was I was selling for $5 million. I had no debt. I was going to get $5 million in a closing, put it in an asset preservation segregated account, and do a 1031 with my $5 million. Now, my buyer says, I'll still close, but I need you to take a note back for $3 million. I can only give you $2 million up front. So that's going to be, if I accept that, most likely this to the seller, a partial exchange, unless I can use one of these tools I'm about to talk about. So if the note is made payable to the seller at closing, that note is going to get taxed, the capital gain on that portion of the proceeds, going to be taxed the seller on the installment basis, which simply means as and when every payment is made to the seller, part of it's a return of basis, part of it's capital gain. So you pay your taxes over time. The only portion I'd be able to include in the 1031 is $2 million, which is a partial exchange. So that's not too good. And the only time that would really benefit me is if my adjusted basis was less than $2 million. Because if not, if my adjusted basis is 3.5 and my gain was $1.5 million, I'm not doing any good putting just $2 million in the exchange. No, I'm sorry, I think I just got that backwards. I'm sorry. If my gain was $1.5 million, that's right. If my gain was $1.5 million and I'm going to have $2 million or $3 million to boot, I'm not going to have any benefit from the exchange because I'm going to have more boot than my gain was. So no benefit. Now, if my facts are changed and I have a very low basis or no basis in the property and I'm putting $2 million into the 1031, I could possibly get deferral on the $2 million and then pay tax on the $3 million on the installment basis. So it's going to depend again on your adjusted basis. But what if you don't want to allow the buyer to go and to impose seller financing on you at all, but you don't want to lose your buyer? Do you have any options? Yes. If the note is made payable, not to the seller at closing, but to the qualified intermediary, okay, then you have 4 options. I'm not going to say any of these are easy solutions or practical, but I'll tell you what they are. So now we're sitting with $2 million of cash and a $3 million note in the QI account. What can happen? Well, if the seller is liquid, they can purchase the note in all or part, the $3 million note, give us $3 million, take the note. Then there's $5 million in the 1031 account, and guess what? We can go use that to buy replacement property. That's terrific. We've done a full exchange. When the seller gets payment on the note over time, then he doesn't owe tax because they deferred it in the 1031. By the way, this is not covered by safe harbor. So when you're going to do seller financing and use one of these techniques, I highly recommend a tax attorney be involved. The seller doesn't have to purchase a $3 million note. A third party can just as easily. A third party can come in and purchase it. As long as the $5 million is in the account, we use it for replacement property. That's all that matters. It could be a short-term note. Maybe the buyer is going to get financing, but it's taking him a little bit longer, and he gets it 60 days into my 180. He pays the note off entirely, and $5 million is put in the 1031 account and used to buy replacement property. Also a very good solution. The final I've never ever seen happen, and that is where the note is used to buy the replacement property. So the note would have to be from somebody like, I don't know, Bill Gates or somebody, and the seller of my replacement property is willing to take that note as part of the purchase price. I don't think that's too likely, but those are some solutions. The bottom line is, if you want to do a 1031, do not agree to seller financing. It will cause you to have issues, and you may not be able to get deferral or full deferral. So I highly recommend against seller financing. Try to make the buyer get financing elsewhere, and it may even be better just to lower your purchase price a little bit and get your deal done. Okay, reverse exchanges. They're going to be on the rise, and the reason they're going to be on the rise is people are seeing opportunities to purchase, and they're going to want to take advantage of that opportunity before they've been able to sell their relinquished property. So that's what a reverse exchange is. It's when you have to close, you want to close, you have to close on your replacement before you've closed on the relinquished. So closing dates are what is critical. It does not matter the contract dates. They are not relevant. It's 2 different ways you can structure reverse exchange. Well, actually multiple ways, but two basic formats. We can either park, which means take title to what you're selling or what you're buying. In a reverse exchange, we hold property, we hold real estate. So in addition to all the exchange documents, there are parking arrangement documents that must be prepared and agreed to. So reverse exchanges are not for the faint of heart. They're much more complex and costly. Avoid them where possible. In other words, if you can get the seller of the replacement property to wait by giving them a large hard-earned money deposit, that's probably a better practical solution than entering into reverse exchange. We need more time to set these type of exchanges up. As I said, we can park either or. Typically, we park the replacement, and the reason is basically as follows. If we're selling for $5 million, then there's no debt. On the day the client takes title to the replacement, they have to have all their equity into the deal, $5 million. Well, if I haven't sold yet, it may be I'm getting bridge financing on my purchase because I don't have the whole $5 million. That's going to require we park the replacement property because the IRS does not measure whether we have our $5 million of equity into the deal while we park the replacement property. They only measure it once we transfer it to the exchanger. And by the way, the entity that we use to park is called an exchange accommodation title holder. EAT is the acronym, okay? Here's how it would look to perform a reverse exchange. And I thought I deleted some of these slides because it's too much for the basic presentation. But basically here we're parking replacement property and releasing it back to you. You still only have 180 days as extended by these notices and revenue procedures to complete your exchange, which means within the 180, we would buy and you would have to sell your property to a buyer and complete your exchange. The numbers, like I said, I deleted the slide for this presentation, but The notice, as I mentioned earlier, applies to reverse exchanges as well. So if we're parking property, you could easily have to July 15th to finish that, and you may have another 120 days, depending on what, if that actually is clarified by the IRS, and we are allowed to get the 80. Okay, I am in 3 minutes or less going to talk to you about using Section 1031 and 121 together. So 1031 is when we're selling investment or trade or business property. 121 is a sale of a principal residence that we've held for 2 of the last 5 years, and it has to be our primary residence 2 of the last 5 years. Now notice something. To get 1031 treatment, it's got to be 1031 on the day you close on the sale. To get 121, it doesn't have to be your primary on the day you sell. It has to have been your primary 2 of the last 5 years. So there's 2 basic ways to use these statutes together. They're as follows, and I'll give you a little diagram. It can be that when you sell your property, part of it's 1031, and part of it's 121. You got a duplex, you live in half of it. You're in a 8-unit building on the Upper West Side. You use 1 unit as your primary, the other 7 are investment rental properties. It could be a situation where you're in a brownstone and on the ground floor is your business. You run whatever you run out of there, and upstairs is your primary. So when you sell that property, it is treated as a split treatment transaction. There's a revenue procedure that goes through a zillion examples and is very good. It's Revenue Procedure 2005-14. And if you have any question about how these calculations are done, refer to that revenue procedure. So that's portion residence, portion 1031. You can also have a situation where you had a primary residence, which was you wanted to sell, but if you sold it, you were going to sell it for like $2 million, and you only get an exemption of $500 because you're married filing jointly, and you have very low basis, and so you were going to pay a lot of gain. You don't want to pay a lot of gain, so you convert your primary to an investment property by renting it out for how long? I recommend 2 years, and then you sell it. And then, let's say you sell it for $2 million, you put $500,000 in your pocket, tax-free under 121, and 1.5 into the 1031. It's the best of both worlds, but it takes tax planning. If you had come to me and you were already under contract to sell your primary residence, it's too late to use this tool. You have to be aware of your tax liability before you sell your primary residence. You might want to convert it to 1031 and take advantage of both provisions on the sale and get the best of both worlds. Now, again, notice it's got to be primary 2 of the last 5 years, not when you sell it. One more thing I wanted to mention here, and that is as follows. If you buy residential property as replacement property in your 1031, and you rent it for a couple of years, and then down the road you convert it to your primary residence, and then you decide you're going to sell it, after 2008, you no longer get your full exemption. It's prorated. It's prorated based upon the time you used it as your primary versus the time it was rented. So you'll never get your whole 500 again. The longer you've used it as your primary, the more of the 500 you're going to get of your exemption. In addition, you have to have owned the property for 5 years in order to get any part of the primary residence exemption. That applies only when you acquire the property in a 1031 exchange. Thank you, everyone. My contact information is at the very end. I also will be emailing you the presentation. I hope you got something out of today's webinar, and I look forward to helping you with your next exchange. Bye-bye.